Welcome everyone to this episode of the Gretchen Casey Show, where I talk to real people in the field of real estate or related to real estate who are not only experts, but they are very generous to come here today and talk about what they do and share their wisdom and their knowledge and their tips. And the goal of the show is to give great information so you can achieve your goals owning real estate and to take some of the guesswork out of what you need to do or who to call and help in guiding you through the process. So today I have Steve Hebden with me, and Steve is a certified financial planner with Rawling Financial. Mm-hmm. And I met Steve from a mutual customer, and Steve is an excellent financial advisor, and I got to know him a bit, and he is my personal financial advisor, and I am very confident referring people to him for investments as well as insurance, and we have a really great relationship in helping people together. So I'm going to turn it over to Steve, and he's going to introduce himself and tell a little bit about his background and what he does.
All right. Well, thanks, Gretchen. Like Gretchen said, I'm a certified financial planner. I work with Rawling Financial and Quadras investment services, providing full range of financial services for people from their disability and life insurance planning to how do we save for our home, when can we retire. So I cover all different aspects of your financial planning needs. And then from there, sometimes I bring in an expert like Gretchen or an accountant, and we work through whatever issue it is you have.
Okay, perfect.
Yeah.
So a big question on many people's minds right now is because of the effects of COVID and the pandemic, how does that affect investments and the economy? So what's happening in the market right now?
Well, right now the market is, it's recovering well. I think early on in the crisis, we saw some real volatility, big drops in the market. But I think right now, people with the various economies around the world starting to get reopened, there's more confidence in the market now. But the big question is, will that continue? I think if we have a second wave, we'll probably see the same thing happen again. Economies will shut down, markets will get spooked, and you'll see a dip again. A lot of my conversation with clients, though, is around, stick to the plan. We had a plan when we started. We should not be deviating from that now when the market is, gone lower or higher. Right? We have a plan. Let's stick to it. We'll rebalance your portfolio like we always have, but we don't make drastic changes in a reaction to something external. We would make changes maybe if you lost your job or something like that happened, but just because the market's volatile, we stayed the course. The big thing for me, and it's all not just now, but I think COVID's highlighted, is you need to make sure that we have an emergency fund available, but then also an opportunity fund, because when the market drops significantly, I had a lot of clients saying, okay, is now the time. So we slowly started moving their money into the market so they could buy some of these funds that had been reduced in value significantly. So in my opinion, the likelihood of a second wave is probably high, depending on which country we're in. But even knowing that, we don't know when it's going to hit, when the market's going to react. So stay the course that you've worked on with your advisor. And if you do have the ability, if the market takes another dip, maybe you increase your contributions to your RSP or TFSA and, take advantage of the downturn. But if you can't do that, you just hold tight. And, if you're close to retirement, likely your advisor's already moved some of your assets to safer investments. So I just would follow their lead and, try to stay as calm as possible.
Great advice. And I like that idea too about maybe it's time to get in.
Yeah. So is now that time? I don't know. But if a second wave hits, I would probably be encouraging some of my clients who do have the ability to, increase their monthly or biweekly contributions and take advantage.
Sounds good. So as you know, I work with people who are buying and selling homes and handle their mortgages, as well as people who want to put their money into being private lenders. How do you suggest people decide about where their personal home, buying rental properties and private lending, how that might fit into the overall wealth building, real estate combined with other investments.
Yeah, so I think real estate, whether it's your primary residence, rental properties, or you're going to be doing private lending, it fits as a part of your overall portfolio. In my opinion, real estate investing is not for everyone, but for some people it works really, really well. So if you have good cash flow, or maybe you're handy and you have the ability to have the rental properties and do some of the work yourself, you can make, we've seen, real estate appreciate significantly, especially over the last sort of 5 years. So it's a great opportunity, but it's not for everyone, because not everyone can handle the midnight phone call and having to go and change a leaky toilet. Like if it was me, I would then be calling a plumber, and then that's eating into my profits. So I think real estate, whether it's you're lending or buying property, it just has to become part of, make sure your advisor knows all about it, and then just becomes part of your portfolio. So maybe and I'm probably not going to put a real estate investor in a real estate investment fund, because now they're going to be too concentrated. So it just becomes a piece of what you're doing. And my only caution is it always sounds really good to everyone, but it's not for everyone, because it can be risky. When 2008, the financial crisis happened, a lot of these values went way down, especially in the United States. And now you owe more than the asset's worth. So can you handle that kind of fluctuation? No, it just sort of fits in with everything else you're doing.
Well, that's a good point too about the real estate investment trusts or funds, because that could be a more passive way that someone who maybe likes the idea but doesn't want those phone calls and being a landlord,
Right.
combined with maybe private lending, to look at can they handle that, and are they open to it?
Yeah. So for me, a lot of my real estate, or all of my real estate exposure, is through a real estate fund, because I don't want the hassle. But I have lots of clients who have no real estate funds, but they own 5, 6, however many properties, and that's the real estate exposure.
Right. Okay. That sounds good. I deal with a lot of people who have challenges saving for their down payment. With prices going up on homes, you need a little more than you used to need 10, 20 years ago. How would you suggest someone go about doing that, saving for their down payment?
Yeah, my favorite vehicle for that is probably the TFSA, the tax-free savings account, because with that account, any earnings we do inside the account are not taxable. You can withdraw it whenever you want, and you don't have to put it back in. So it allows you to avoid some tax, and then you just sort of set up we determine how much money am I going to need, and when do I want to buy the house, and sort of reverse engineer it to say, okay, you need to save X number of dollars per month. The other option that some people have, if they're having trouble getting to the down payment amount, would be using their RSPs. So they could do a first-time home buyer's withdrawal, use that as the down payment, and then over the next 15 years, they can repay their RSPs. So they're just essentially borrowing from themselves. The downside of that is you're not getting credit when you're putting the money back in. You've pulled the money out of the market. But for a lot of people, it's the best option, because maybe their employer's been providing them a group RSP. So you could use that. And the other nice thing is, if you don't have the money in a given year to do your repayment, you can always skip the payment and just have the minimum repayment requirement added to your income. So if you don't have the $1,000 put back in, just add the $1,000 to your income, and it's just going to cause a bit of a tax implication, but generally not too drastic.
And if you do that, do you have to then still pay it back the next year?
Nope. So they'll just consider that the payment.
Oh, okay.
All the government's concerned about is that they're going to get their tax dollars. However they get it, whether it's when you're retired or it's now, they just want the revenue. So that's an option for people as well. And then we look at other things like, do you have like a life insurance policy that has cash value in it? Can you borrow the money out of there for your down payment, or do you cash in a little bit of it and you can use, the insurance companies don't care what you use the money for. So maybe you borrow 10, 15, 20,000 out of there to help with the down payment.
That's a great tip.
Add one in plan. Yeah.
I love that. Didn't know about that. Wow. I'm glad we're having this call today. I'm getting very educated.
You can't just buy a policy and it's there. You would have had to likely bought the policy years ago, and then you go, oh, right, there's cash value here. Or maybe you're lucky and grandma bought you one when you were born and there's money there. Yeah.
Okay, that's
Yeah.
excellent to know.
Yeah.
Okay, cool. I'm going to add that to my doing a flyer about all the ways to get a down payment. So I'm adding
Yeah.
that.
There you
Perfect.
go.
Okay, so another area that you handle is insurance. And why is it important for people to have insurance when they're buying a house?
Yeah. So that question's a little bit different for everyone. But let's say you're a couple, you have small kids, and now you've got a $500,000 mortgage. We want to make sure that there's enough money going to come into the household should you or your partner pass away too soon. Because there would be, it's not a whole lot worse than one of the partners passes away, but now they're surviving one can't afford the payments. They have to sell the house, and not only did the kids lose a parent, they lose their home. So I think it's very important to make sure you have enough life insurance in place to cover the mortgage, long-term debts, and then some extra funds to support the family's lifestyle, because you don't want to lose someone and then also lose your lifestyle. And there's different ways to buy it. I recommend people buy individual policies versus getting it through the lender, because typically it works out cheaper over the long term, and the coverage amount never goes down. And we can do life insurance based on a term, so length of time the premium will be fixed. Or you can buy permanent coverage, so the premium stays fixed forever. Maybe it generates cash value. So life insurance is very important, but so is disability and critical illness. So if you get, you're unable to work because, let's say, you're off with a heart attack, your disability insurance would kick in after your waiting period. And then also you'd be receiving a lump sum from your critical illness policy to do whatever you need to do. Whether that's treatment or, you meet the qualifications for it and you don't need to seek treatment. You just have some extra cash flow in the house to deal with whatever you want. So I think having those two in place is also very important.
Well, you mentioned heart attack. Is that considered critical illness? Would cover that, or disability?
Both would cover it.
Oh, they both.
So if you have meet the requirements of the heart attack, the policy would pay out. Let's say it's $100,000, but then you're going to be off work for a year for whatever reason. Your disability is also going to kick in after your waiting period.
Okay.
The difference between the two products really is, you can think about disability insurance are the brakes in your car. It sort of slows the pain, and you get a percentage of your income coming in. So it slows down the pain of being off work. And then the critical illness is more like the, excuse me, your airbag. It deploys, it throws the $100,000 into your bank account, and the insurance company doesn't care what you do with it. So it's a one-time payout. You only have to qualify for the payout once, versus disability. They're going to be checking in with you saying, are you still unable to work? Can I have a doctor's report or whatever to continue the payment? So it's good to have both. Because you don't want to default on your mortgage because something bad happened to you.
Yeah, for sure.
Yeah.
Okay.
Yeah.
Well, my last question, what is one piece of advice you'd have for Canadians today?
Budgeting. Control your cash flow. If you're lucky enough to not need one, that's great. But most people, especially now with so much uncertainty in the economy, will the government income supports, how long are those going to last? So we need to make sure that we're spending money wisely. We're not accumulating unnecessary debt. And we're monitoring our emergency fund, because we're in very uncertain times, I think. But if you're properly prepared, you can weather the storm and come out okay the other side, if not better, because you have the ability to maybe put some more money into your savings. So I think budgeting and, concentrating on not taking on debt unnecessarily.
Okay. And do you have any specific apps or anything that you recommend for budgeting, or just regular create a spreadsheet?
I'm kind of old school that way. I do a lot of spreadsheet. I have lots of clients who use different apps like Mint and things like that, and they seem to really like it. But for myself personally, I think I find a lot of people find it easier to just, if you're keying in the numbers, you're actually really paying attention to where the money's going versus having it auto populated for you. Because you might go, maybe I didn't need to spend that much money doing X. So I like the actual keying in, but for some people, the apps are great. But
Yeah. Okay.
Yeah.
That's good. Excellent. So if somebody wants to reach you for help on investments or insurance, how can they get a hold of you?
Yeah, so you can reach me by email at Steve, so Steve, at rawlingfinancial.com. So RAWLING financial.com.
Excellent. Well, thank you so much for sharing all this great information today. I really appreciate it.
No, I'm happy to do it, Gretchen.
Okay. Take care.
You too.